Your credit score is one thing that you have the most control over that can have the biggest impact on your life. There's literally nothing else that can save you hundreds of thousands of dollars over your lifetime the way having a good credit score can do. This right here is the guide that I wish I had when I was first getting started with building my credit. So grab some popcorn and let's get started. For starters, what exactly is your credit score? Very simply put, your credit score is a 3-digit number that banks and lenders use to determine how responsible you are. Generally speaking, the higher your credit score, the more banks and lenders are going to be willing to give you money and give you the best rates on loans and credit cards, which can end up saving you a lot of money in the long run. It's important to understand that, very broadly speaking, there are 2 different credit scores lenders will typically look at when deciding on your fate. What I meant to say was when deciding on whether or not they want to give you money for a loan. Yeah, that's what I meant. You've got the FICO score and the Vantage score. Your FICO score could range anywhere between 300 and 850, with 300 being the lowest possible score and 850 being the highest. Your Vantage score also has a range of 300 to 850. Of those 2 scores, I would recommend that you pay attention to your FICO score because that's the score that's used by 90% of lenders to determine whether or not they're going to give you money. And just for the sake of simplicity, just understand that when I'm saying your credit score, I'm actually referring to your FICO score. Yes, you do have multiple credit scores, but your FICO score is by far the most important. Next, let's talk about who actually determines your credit score. There are 3 credit reporting agencies that control your fate. Your credit score. You've got Equifax, Experian, and TransUnion. These are the 3 credit reporting agencies that will collect your data and your information about your financial life, and they'll turn that information into a credit report. It all looks a little something like this. When you use credit cards or take out loans, how responsibly or irresponsibly you use these products is reported to one or all of the 3 credit agencies. The agencies will then use the information that's reported to them by the lenders and creditors to create your credit report. And so you'll have 3 different credit reports, one from each agency. Those credit reports are then used to create your credit score. Again, we're just focusing on your FICO here. But then your credit score is what will determine whether or not future lenders will want to continue extending credit to you. And then it just goes full circle. This is why it's going to be critical that you understand everything in this video, especially in a little bit when we talk about how to build and maintain a good credit score. Next, let's talk about how your credit score is calculated. And we're going to specifically look at how your FICO score is calculated. First, let's take a look at your payment history. Your payment history makes up 35% of your total credit score. This makes it the most important factor to focus on when trying to build and maintain your credit score. The goal with your payment history is to keep it at a 100%. You see, because your payment history is measured by your ability to pay your bills on time. And so if you consistently pay your bills on time 100% of the time, then your payment history will be 100%. But if you are constantly missing payments on your bills, then that in turn is going to have a negative effect on your payment history, which will severely damage your credit score. Now, ideally, you want to keep your payment history at a 100%. You may hear advice out there saying that anything above a 90% is good. Yes and no. Your goal should be a 100% payment history because the moment you go and miss even just one payment on a utility bill or a credit card or a car loan, that one missed payment is going to have drastic implications on your credit score. But don't worry, if you have late payments on your credit history because you forgot about a bill or something, it was an accident, it doesn't mean that it's going to permanently affect your credit score. After 7 years, the late payment will fall off of your report and your score will increase. The next important factor that makes up your credit score is your credit utilization. Credit utilization makes up 30% of your credit score, making it the second most important factor to consider. Credit utilization sounds complex and fancy, but I promise you it's not. It's basically just referring to the portion of your available credit limit that you're using at any given point. Let's say, for example, that between all of your credit accounts, you have a combined credit limit of $10,000. This $10,000 represents 100% of your credit limit. Let's then say that you use one of your credit cards to buy a new TV for $1,000. Considering that your total credit limit is $10,000, you're now using 10% of your credit limit. Ideally, you want to keep your credit utilization below a 30%, and honestly, under 10% is even better. The easiest way to keep your credit utilization down is to simply pay off your credit card balances in full every single month. And so in the example of you buying a $1,000 TV with your credit card, you would simply pay off that $1,000 balance at the end of the month. Paying off your balances in full not only keeps your credit utilization low, but it will also prevent you from having to pay unnecessary interest on your credit card balances. You see, because the only reason that you would ever have to pay credit credit card interest is if you weren't paying off your balances in full every month. But if you are paying off your balances in full, or at least keeping your credit utilization low, then it won't have a negative effect on your credit score. There's also a trick that you can use to give yourself access to more of your credit without actually increasing your credit utilization. Let's use the example from earlier and say that you have a total credit limit of $10,000. What you can do is go to each of your individual credit cards and request credit limit increases. By increasing the credit limits of each of your individual credit cards, you increase your overall total credit limit. Now, recall the example from earlier when you bought a new TV for $1,000 using your $10,000 credit limit. In this example, you would have a credit utilization of 10% because $1,000 is 10% of $10,000. But now, since you've increased the total limit across all of your accounts to say, for example, $20,000, this time around, when you go to buy a new TV for $1,000, instead of using 10% of your total credit, you'll now only be using 5% of your credit. It's not that you're spending more money, right? It's still the same $1,000 TV, but because you have a higher credit limit, you've effectively cheated the system. I'm certainly not advocating that you should go and increase your credit limit just so that you can increase your spending with it. I personally have a total combined credit limit of about $95,000. Does that mean I'm gonna go to Amazon.com and spend $95,000? Of course not. Maybe. But by increasing your credit limit, you can still keep on spending the same amount of money on your credit cards as you normally would, but still keep your credit utilization low. Let's talk about the length of your credit history now. This credit factor makes up 15% of your credit score and measures the combined length of time that you've had all of your different credit cards and credit accounts open for. For example, let's say you have 3 credit cards in total. One card has been open for only 1 year, the other you've had for 3 years, and then the final card you opened up a long time ago, perhaps 8 years. To measure the length of your credit history, the credit reporting agencies would take all 3 of those credit cards, add the length up, and then divide the total length by the number of cards. In this case, giving you 4. And so 4 years would be the average age of your credit history. Generally speaking, having a credit history of between 7 and 10 years is the absolute best case scenario. Anything between about 4 and 6 years puts you somewhere in the middle, and anything under about 3 years is considered a pretty short credit history and could have a negative effect on your credit score. Now, the age of your credit doesn't have a huge impact on your credit score because it only makes up 15% of your combined credit score, but there are going to be some things that you can do to ensure that your age of credit continues increasing. For starters, it's never a good idea to go and close old credit cards. I know like the natural inclination if you're not using a credit card anymore is to just go and close it, but that can actually hurt your credit score. Let's go back to the example from earlier. You've got 3 credit cards with an average age of 4 years. Well, let's say for example that you haven't used this credit card right here in over 3 years. And so what's the point of keeping it, you think to yourself? And so you close it. The problem with this is that you've effectively just erased 8 years from your total age of credit. And so now your total age of credit will only be based on these 2 cards. And if we calculate the average of these two, 1 year plus 3 years divided by 2 is 2. And so now, instead of your total age of credit being 4 years, it's only 2. And as a result, your credit score will drop. And so the first tip to maintaining a good, healthy age of credit is to keep accounts open as long as you possibly can. Even old credit cards that you're no longer using, just keep them open. You may have to use them occasionally because some credit cards will close after a certain period of inactivity. Typically, after a couple of years, you'll have to use the credit card at least once to keep the account open. The next tip for increasing your total age of credit is not opening up too many new accounts at once. Let's say that you have 3 credit cards, but then you open up 3 more cards all within the same year. Well, now your average total age of credit will drop because instead of dividing the totals from these 3 cards and dividing by 3, you now have to combine the totals from 6 cards and divide by 6. This will of course drop your total average. I'm not saying that you shouldn't go and open up new accounts because the only way to build your credit in the first place is by opening up new accounts, but just try to avoid opening up too many accounts within one short period. Next, let's talk about your credit mix. Your credit mix makes up 10% of your total credit score, and it's referring to the different types of credit that you have on your file. For example, mortgages, loans, credit cards, these are all different types of credit accounts. Now, it's not necessarily required that you go and open up all these different accounts because not having some of these accounts won't hurt your credit score, but lenders do see it as a bonus. It shows them that you're able to effectively manage multiple lines of credit responsibly. Now, there are 3 different types of credit accounts that will appear on your credit report. They are installment credit, open credit, or this can also be called open accounts, and revolving credit. Installment credit are things like your mortgage, student loans, car loans, personal loans. These are all loans that have fixed end dates that require you to pay a specific set amount each month over a certain period of time until you've paid off the loan typically with interest. Revolving credit are things like a credit card, a HELOC, a home equity line of credit is another example of revolving credit. Revolving credit doesn't have a specific end date like how installment credit does. Instead, you're given a line of credit which is available for you to use whenever you want for anything that you want, like a credit card. And finally, open accounts or open credit. These are things like charge cards. Some utility bills are actually considered open credit. With open credit, you are fully expected to pay off your balances in full at the end of each month. So for example, if you don't pay your electricity bill, not only are you risking losing your electricity, but you're also risking the fact that the utility company can and probably will end up reporting that late payment to the credit reporting agencies. And the last of the 5 credit factors is new credit. New credit makes up 10% of your credit score. Another name for new credit that you may recognize are hard inquiries or hard pulls. Every single time that you apply for a new line of credit, be it a credit card, a loan, a mortgage, anything, the lender will first check your credit history just to make sure that you're somebody who they feel comfortable lending money to. When they do this, when they pull your credit score, that is known as a hard inquiry, and that hard inquiry may take about 5 or less points away from your total credit score. Additionally, hard inquiries only stay on your credit report for 2 years, and then after the first 6 months, they start to have less of an effect on your credit score. And so now that we got the basics out of the way, it's now time to start talking about the stuff that I know that you guys like. The practical stuff. In this part of the video, I want to discuss with you guys how you can realistically start building your credit starting as soon as today. There are a lot of different ways that you can go about building your credit score. I mean, you could hire a company to do it for you. You could use a credit building loan, which will cost you money in interest. Now, there's nothing wrong with those things, but in my opinion, there are much better ways that you can build your credit and for free. So here they are. The first way is by getting a secured credit card. A secured credit card is different from, say, a traditional credit card, right? So like with a traditional credit card, the credit card company gives you a set credit limit based off of your credit worthiness. You can then go on to use that credit to buy things. Even if you don't have the money at that moment to pay for those things, like in your bank account, you can still buy it with your credit card. A secured credit card works a little bit different. With a secured credit card, you are required to make a security deposit into an account first, and then that security deposit becomes your line of credit. The credit card company will give you a credit card, but your line of credit is only as much as you deposited into the account when you first opened it. Now, there are some secured credit cards that will provide you with a higher credit limit than what you deposited initially. For example, the Capital One Platinum secured card might give you a $200 credit limit but only require a $99 deposit. Because you have no established credit or potentially even bad credit, the security deposit is in place just in case you miss any payments, or if you just disappear and you don't pay off your balance, the bank can just take that deposit and pay off the balance in full. And of course, you will get this deposit returned back to you once you're finished with the card. After several months of using the card, building your credit, and just proving that you can be responsible, many credit card companies would be happy to approve you for a traditional credit card. The second way to build your credit is to become an authorized user on someone else's card. An authorized user is somebody who's allowed to use someone else's credit card, typically like a relative or a spouse or a close friend. Authorized users are usually issued their own credit card with their name on it, but the account itself still belongs to the primary card holder. The biggest advantage of being an authorized user is being able to build your credit by piggybacking off of the primary card holder's good credit habits. When the primary card holder pays their balances in full each month and keeps their credit utilization low, not only are those activities being reported to the credit reporting agencies for the primary card holder, they're also being reported for the authorized user as well. Now, this can have an inverse effect as well, and so you have to be 100% certain that if you're going to be added to somebody else's credit card as an authorized user, that that other person is an actual responsible adult. The third way to build your credit is to use a cosigner. If you have no credit or bad credit, the only way a credit card company will let you open up a traditional unsecured credit card is if you have a cosigner. And your cosigner has to be somebody who has a good credit history, a good credit score, and a consistent income. The lender wants to be sure that if you can't afford to pay your balances in full, that they can then turn to your cosigner and say, pay up. Now, one big caveat to this point is that a lot of the major credit card companies actually don't allow cosigners. As you can see on your screen, the only 2 major banks that allow cosigners for credit cards are Bank of America and US Bank. The last way you can build your credit is by using alternative credit cards. Perhaps you don't want to use a secured credit card because you're not really interested in having to pay that upfront deposit. Well, with an alternative credit card, you actually don't have to pay a security deposit, and you still get a line of credit just like you would with a traditional credit card. This is a list of the best alternative credit cards that you can open with some basic details about each card. I'm not going to go over each card individually, but you can pause the video here if you want to take a look longer. The way alternative credit cards work is that instead of looking at your credit score as a factor of approval, They instead look at things like your income, your employment status, and other bank account information. In other words, if you just have a consistent job, you have good consistent income, you even have a little bit of money saved up in your savings account, then your chances of being approved for a alternative credit card, even if you have a bad credit score, increases greatly. Okay, that's all I've got for you in this video. Hey, thank you so much for watching. You're absolutely amazing. And as always, I will see you again very soon. Take care.